The Roaring Twenties. The First World War had just ended and America was on the winning side. People were positive for the future and see that the economy was booming. America had just entered a new age of economic prosperity and life was becoming better. Troops are back, women are entering the workforce and more projects are being taken up again. People are earning way more money and they spend that to buy new inventions and products such as the automobiles, radio, cinema, aviation, television, medicine and so much more. This spending further boosted the economy, interest rates were low and people started to borrow money to invest. The stock market was becoming pretty popular among everyone. This further caused stocks to go up. The stock market became an easy way to make money. The Roaring Twenties, the greatest period of economic prosperity and growth. Everything was amazing. Stocks only went up and the economy went up together with it. Until it didn't. You see, with more and more people buying stocks and using margin, aka borrowing money to buy stocks, stocks have become overvalued and too high compared to what was actually going on. Production was not increasing as fast and people weren't actually buying that much. This was not good. This led to people earning less and it became harder to pay off the debt or margin that they had taken up to invest in the stock market. So interest rates began to rise and stocks started to go down. Then came Black Thursday, October 24th, 1929, when the Dow Jones Industrial Average fell 11%. The headline in newspapers were, Wall Street in panic as stocks crash. Turns out, stocks don't only go up. Now there are lots of reasons for the Great Depression, but looking back, it can be pretty worrying. New inventions and products.
Tonight, the information superhighway and one of its main thoroughfares, an online network called Internet.
Check. More and more people are investing in the stock market.
Becoming an investor is the new American dream, just like home ownership was before. I asked Vlad about GameStop.
Check. Interest rates were low.
We judged that the risks to the U.S. outlook have changed materially. In response, we have eased the stance of monetary policy to provide some more support to the economy.
Check. People using margin to buy stocks. Check. Stocks overvalued. Check. Inflation. Check. In this video, I want to compare the main factors that led to the 1929 Great Depression and compare it with what's going on in 2020, since there have been lots of news about the market crashing and the bears are starting to come out of hibernation. Number 1 is buying stock on margin. Margin was one of the main causes of the 1929 market crash, and margin was commonly available for 50%. So in order to buy a stock, people would only have to put up 50% of the money, as the broker would be able to put up the other 50%. So this meant that let's say you wanted to buy Tesla stock, and Tesla stock was currently trading around, $420 per share. This means that in order to buy that stock, you'd only have to put up $210 and you can own that stock, as your broker would pay the other 50%. And this is great when stocks are going up. However, do note that you have to pay interest on your margin, and this depended on which broker you use. So let's say Tesla stock goes up to $800. So now your account is worth $800, and if you want to pay per hand your Tesla stock and sell it, your account will be valued at $800 and you have to pay back your margin or debt that you got for $210. So now your account is valued at $590. But your original investment was just $210. So that's an increase of 180%. But Tesla stock only went from $420 to $800. This is a 90% increase. So while Tesla stock has only gone up by 90%, your account has gone up by 180%. So this is the benefit of margin. So you can amplify your gains. However, it also works in reverse. Let's say on a random Friday, 5 minutes before market opens, Elon Musk tweets, Tesla stock is too high in my opinion. So let's say Tesla stock falls from $420 to $300, and even though you have diamond hands and became a long-term investor in Tesla because you actually believe in the company and have strong conviction, margin calls exist. And this depends on each broker. So let's say your broker has a maintenance margin of 35%. So this means that if your original investment is worth less than 35% of the account, then you would get margin called. In which case you have to do one of two things. One is either deposit more money into your account to make sure that your margin maintenance is above 35%, or your stock would be automatically sold by the broker. So if Tesla dips below $323, your account will now be valued at $323, and if you minus the margin or debt that you got from your broker, which is $210, your actual account value is only $113. And this $113 is less than 35% of your account. So now you'll be margin called. So Tesla stock fell from $420 to $323, and that's a dip of 23%. But your account fell from your original investment of $210 to now only $113. So that's a dip of 46%. So you can see how margin amplifies your gains and also amplifies your losses. So this was basically what happened in 1929, but margins were available more in the ratio of 3 to 1 or 2 to 1. So since stocks went down because production wasn't able to meet the demands and high expectations of the stock market, many more people were margin called. And it's estimated that 300 million shares were bought on margin in 1929. So as stocks began to tumble because of its overvaluation, more and more people were getting margin called. So they either had to deposit more money into their account or they had to sell their stock. But since people were earning less because of lower production, they couldn't deposit money into their account and they had to sell their stock at whatever price it was. So this caused stocks to tumble down even further as more and more people were starting to sell. And this led to even more margin calls and even more selling, and this led to a cycle that collapsed the stock market. Number 2 is inflation. So the money supply in the US increased by 24% from $15 trillion in 2019 to now around $19 trillion in 2020. And it's expected another $5 trillion will be added because of the stimulus relief package and other developments. And also the S&P 500 increased by 22% from January of 2020 to March of 2021, while the Dow Jones increased by 14.47% in the same period. Since there's more money in the economy and the economy is going to open again after COVID-19, and people are going to buy new products, and there's going to be a shortage in supply, leading to even more inflation. And this can lead to the Fed increasing interest rates, which can lead to deleveraging. And here's a clip of Ray Dalio explaining it.
This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As incomes fall and debt repayments rise, borrowers get squeezed. No longer creditworthy, credit dries up, and borrowers can no longer borrow enough money to make their debt repayments. Scrambling to fill this hole, borrowers are forced to sell assets. The rush to sell assets floods the market at the same time as spending falls. This is when the stock market collapses, the real estate market tanks, and banks get into trouble. As asset prices drop, the value of the collateral borrowers can put up drops. This makes borrowers even less creditworthy. People feel poor. Credit rapidly disappears. Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%. So the stimulation ends.
And while one of the solutions to deleveraging is to print more money, the US can't do that as they already printed so much money, and printing more money would just lead to even more inflation, which would just make the problem worse. This is a terrifying situation for financial institutions and people all around the world. And in a depressing way, Bitcoin might actually reach $1 million because of this. In fact, now it's reaching new all-time highs and it's around $62,000. Well, the markets are tumbling, but the Fed thinks that instead of paying more prices, people just wait. So when there's low supply and the prices are increasing, people won't actually buy anything. So this would prevent prices from increasing and inflation, and thus prevent a global financial disaster. Number 3 is overvaluation. And one reason the stock market crashed in 1929 is because of overvaluation of stocks. In December 1929, many expert economists, including Keynes and Irving Fisher, felt that the financial crisis had ended. By April 1930, the Standard & Poor's 500 Composite Index was at 25.92, compared to 1929 close of 21.45. And there are good reasons for thinking that the stock market was not obviously overvalued in 1929, and that it was sensible to hold stocks, or diamond hand, in the fall of 1929 and buy the dip, or buy stocks, in December of 1929. Also, Irving Fisher's stock market crash and after offers much data indicating that there was real growth in the manufacturing sector, and the evidence presented goes a long way to explain Fisher's optimism regarding the level of the stock prices. And what Fisher saw was manufacturing efficiency rapidly increasing, as was the manufacturing output and use of electricity. The financial fundamentals of the stocks were also quite strong. During 1928, the price-earnings ratio for 45 industrial stocks increased from approximately 12 to approximately 14. This was over 15 in 1929 for industrials, and then decreased to approximately 10 by the end of 1929. While not low, these price-to-earnings ratios, or PE ratios, were by no means out of line historically. It would be considered reasonable by most market analysts today. For example, the PE ratio of the S&P 500 now is around 40. However, there was some sentiment in the media and the government that stocks were overvalued. Although it can be argued that the stock market was not overvalued, there is evidence that many feared that it was overvalued, including the Federal Reserve Board and the United States Senate. By 1929, there were many who felt the market price of equity securities had increased too much, and this feeling was reinforced daily by the media and statements by influential government officials. Comparing to the present day, this could be stocks like Tesla. So electric vehicle manufacturers Tesla and NIO delivered 540,000 cars in 2020 and were valued at around $940 billion. But while the next 12 largest valued vehicle manufacturers, such as Toyota, Volkswagen, Daimler, General Motors, BMW, Volvo, Ferrari, DWM, Stellantis, Honda, BYD, Ford, had a market value similar to just Tesla and NIO at around $950 billion, they had sold well over 50 million cars. So Tesla and NIO are valued about 100 times more than traditional automobile manufacturers. But many people have said that this is because of Tesla and NIO's technology and their dominance in the electric vehicle market. So that's why Micheal Burry, who famously appeared in The Big Short and secondly known for, predicting the 2008 housing market crash, said that Tesla could fall 90% to around $100 per share and it wouldn't cause major change in the financial markets. And so far, it's looking like he's right, with Tesla falling 35%. So what do you do now? Well, no one really knows for certain, and that's the truth of the stock market. And you can kinda predict what's gonna happen, but we're not really sure. And one interesting thing to look at is Micheal Burry's tweets. And he's saying that inflation is gonna be coming, and that he doesn't believe in Bitcoin or Tesla, but he deleted all his tweets. But you can check out all his tweets by going to Micheal Burry archives. So thank you for watching this video, and I hope that you found it useful. You can check out this video about how Elon Musk replied to one of my tweets, or this video about crypto, which seems like it's going to be increasing, especially with inflation coming on.